With an online presentation by Christian Labetzsch from Blocksize Capital. He will speak about direct market access in crypto and the start of a new era in institutional trading. Christian, can you hear me?
Yes, I can.
Okay, then the stage is yours.
Many thanks for the intro and hello to Frankfurt. This presentation is about direct market access in crypto, and I will discuss the question whether this will mark a new era in institutional trading. My name is Christian, and I'm one of the two managing directors at Blocksize Capital. Before we dive into that, just very briefly what Blocksize offers. And as you can see on this slide, Blocksize Capital offers a trading infrastructure and solution specifically for direct market access. What does that mean? We connect on the one hand side crypto exchanges that have order books available and institutional clients that want to trade directly on an exchange through an infrastructure that we provide. This includes market data, low latency market data, but also way more importantly, a smart order router and infrastructure for post-trade settlement. What that means and why this is important, we will answer throughout this presentation. Before we start, just very, very briefly, what is the difference between OTC trading, over-the-counter trading, and direct market access? What is even my direct market access and why is it relevant? So let's have a look at what direct market access is. Usually when we speak about direct market access, we're speaking about trading directly on the exchange. That means you have access to the order books there, full transparency about market depth, but also about the fees. Usually when we speak about DMA, an intermediary brokerage firm will be acting as your legal counterparty. And will enter a contract with you that then will legally and also electronically route an order to the respective exchange. This is a common setup that we see in traditional brokerage and trading, mainly for highly liquid equities, for example, and has been established as common standard in the traditional world. I think the major advantage of trading direct market access is the transparency. You not only see the order books, but you also have full price transparency and full fee transparency. Why this is relevant, we will also discuss in the next couple of minutes. As opposed to that, we're speaking about OTC trading when an OTC broker represents the legal counterparty of a trade. And this OTC broker usually provides clients with a quotation, an RFQ, to buy or sell crypto. Usually you have no transparent order book or no access to the order book and no transparent fees. The price usually includes the fee. It's an all-in price. The current crypto market is being dominated by big liquidity providers or OTC providers, because what they do is throughout their mechanisms they have established, they provide liquidity currently to institutional clients and clients trading crypto. And this is why we see a very big adoption in the current environment of OTC brokers that provide institutional clients with crypto. However, there may be a change in direction in the next couple of months, looking at the different options that we have and the benefits even of, especially of direct market access. So let's speak about the 5 key facts of direct market access. Key fact number 1. Direct market access provides direct order book access. That means you can see before trading whether there will be a market impact of your order, for example. You can directly see how much liquidity for a specific pair on a specific exchange is available at this very moment. You can also determine the market impact if there's any of your order pre-trade. And we will also see that usually one exchange does not provide sufficient market depth for larger institutional clients. This is why an aggregation of different exchanges combined with direct market access makes really sense. We've prepared an example showing how, for example, an order book looks like, what it looks like, and how the aggregation can provide benefits to institutional clients. So what you see here is a simple order book for one exchange, Bitstamp in that example, for the pair BTC Euro. You can see the current market depth, and through our solution that facilitates direct market access, you can add other pairs or look at the market depth for other pairs, but way more importantly, you can aggregate exchanges, you can add exchanges. And this is, in this example, you see that Bitstamp has like 45 BTC market depths at the time of recording, which equals 1.7 million, which is probably not sufficient for bigger clients. However, through aggregating exchanges, you can see that the market depth now is more than 1,000 BTC, providing the comfort and the liquidity needed for institutional clients, whilst having full transparency about prices and even fees. So this is one advantage that we see when speaking about direct market access. Let's have a look at key fact number 2. We don't only have transparency with regard to order books, we also have the opportunity to execute at best prices available, even across different exchanges, and we have full fee transparency. That means the prices that traders see on the exchange, they're exclusive of fees, and the fees are being displayed separately. Also, especially when we combine the way of routing those orders to exchanges, we can make sure that an algorithm in our system utilizes the best prices, the best fees, and also the optimal order book depths on the different exchange. And here you can see another example how this works. This is our order entry mask, and we're placing an order, we're simulating an order of 100 BTC. It's no surprise that, obviously this order will be splitted across different exchanges to just make sure that, first of all, the order is being executed without market impact, but also to utilize the best prices and fees on the market. You can see not only your execution price, but you can see in a separate column your fees for each exchange, giving you full transparency, not only post-trade, but also ex ante, in order to make sure to also comply, if required, with regulatory requirements for displaying costs and calculating them. It also usually gives you savings depending on the market environment and the order book depth and the cryptocurrencies you're trading. And even for highly liquid pairs, such as BTC Euro, you can see that an order will be splitted across even bigger exchanges. The impact and the benefits of using direct market access and combining exchanges for even less liquid pairs is way higher. Key fact number 3, we not only have cost transparency, also usually you can benefit from lower prices. On the right-hand side, you see that we went through the exercise of just looking at different tiers, cost tiers of exchanges that are in the range of an institutional trader. And those tiers, they accrue for 30 days average trading volume. So you can see that there's still a huge difference between the different exchanges. However, prices compared to offerings available in the market by especially OTC brokers are comparably low. And one advantage is that when you use an intermediary brokerage firm acting as counterparty and aggregating volume of multiple clients, you will also benefit indirectly from reduced fees. Because when they aggregate volume and they exceed specific thresholds on the different exchanges, the fees will be even lower. This is one of the major advantages, having an intermediary in between that is aggregating orders for multiple clients. Something that is important, though, is that there may be additional charges for deposit or withdrawals. This is the pure trading fee that we see. Now let's speak about one of the probably most important key facts when we speak about direct market access, and one of the biggest issues that we see in the market that especially OTC brokers resolved. This is just in a very simple view, the value chain that we have in trading cryptocurrencies. On the left-hand side, we have institutional clients and their trading desk. They have custodians safekeeping their fiat money, euros, USD, and they have licensed crypto custodians safekeeping the assets. So when currently trading on highly retail-dominated crypto exchanges, the standard flow foresees that actually before you can trade, your money or your cryptos will be deposited to the respective exchange, leading to counterparty risk for the time of your assets being stored on that crypto exchange. But what's even worse is that dependent on the banking partner you use or dependent on the protocol that you use for an on-chain transfer, it can take a lot of time until your funds were deposited into the respective crypto exchange. So for fiat, we're speaking about T+1. For crypto, we can even speak about 60 minutes. You want to buy or sell right now. You don't have a day or even 60 minutes to wait for your funds to arrive at the crypto exchange. And this is the biggest problem that you have at the moment, because those crypto exchanges do not provide a post-trade settlement that is independent of the trading cycle, or provide credit lines or an earmarking with existing custodians. However, we see that those crypto exchanges are really trying to attract institutional traders and meet their requirements of trading in a different way, especially out of their existing custody and safekeep accounts. So what we see at the moment is that together with partners, for example, our clients are working on a solution that allows to trade without having the assets at the point of trade at the exchange. So what could the flow look like? And what is a solution that definitely needs to be established in order to allow for adoption in institutional trading? That an institutional client can, of course, through their existing infrastructure, place an order with the licensed broker dealer. No phone calls, simply an electronic order, fully automatic through APIs and an existing trading solution that the system will be plugged into. The second thing is that in a fully automated way, a proof of funds can happen between the licensed broker dealer and the respective custodians to see whether the funds are actually there in order to execute a trade. Only then the order will be executed, that means routed to an exchange. As you can see in that flow, no deposit happened at the current stage. The order will be just routed to the exchange. And now the key element of that entire cycle is that a settlement instruction through the licensed broker dealer can be sent to the respective custodian and to the exchange. That means if I sold my BTC, the licensed broker dealer will send a settlement instruction to the custodian to send the sold BTC through an on-chain transfer to the exchange, and through the existing APIs to an exchange, the corresponding amount of euro, for example, will be withdrawn from the exchange and deposited into the fiat account of the custodian. This is very similar if you are familiar with how a trade or post-trade cycle works in a traditional world. This is very similar to what actually settling a traditional instrument looks like. However, it's kind of very complex to build that solution, not only from a technical perspective, but also complying with all the legal requirements. We don't have a CSD, a central security depository, in that to facilitate that, nor a CCP for clearing transactions. So it all needs to happen through a proprietary infrastructure being built across the different market participants. And I mean, we just heard that in the presentation before this presentation. We are at the very beginning. A lot of big companies, especially big banks and institutional clients, they are currently trying to figure out how safekeeping of private keys work. That means we're even earlier stage when looking into those end-to-end processes that allow a more efficient collateral and liquidity management. But something is very clear to me, since I know that it's already being worked on that solution. It's only a matter of time. But until this has been resolved in direct market access trading, big OTC providers that can act as LPs because they have deferred post-trade settlement cycles will still dominate the market. But eventually this will be sorted out, and then direct market access, especially for highly liquid pairs, will become the dominant way of trading cryptocurrencies on that market. And then something that we observe is institutional clients that want to trade more exotic tokens and coins struggle to get access to them. Either the market liquidity is, of course, not sufficient enough, or their partner, an OTC broker, does not support that currency. What we see is a convergence and an integration of decentralized finance application into direct market access. Because something you have to keep in mind is when you have the technical ability to settle a trade with an exchange through an on-chain transfer, and you have anyway the connection to a crypto custodian and to an exchange, in this case a decentralized exchange, you will be able also as licensed broker dealer to facilitate the trade even with a decentralized exchange or an automated market maker. So what I'm trying to say is that integrating those solutions that have decentralized order books directly on-chain or accessing an automated market maker is not that much of an effort in terms of how you structure your infrastructure and facilitate trading for additional pairs. Also, a big advantage in this setup is that compared to a centralized exchange, you don't have a counterparty risk being represented by another party. You are directly interacting with a smart contract that makes sure that assets are being exchanged through atomic swaps. I mean, your counterparty risk will be potentially lower. However, it will be different because you're now interacting with an open source smart contract and not a regulated entity. But the advantage clearly is that we have potentially lower fees on those DEXs, and of course, access to more exotic pairs. And as you can see, just simply looking at the decentralized exchanges, we have Serum, which is the leading decentralized exchange on Solana. We have Loopring, an exchange on a layer 2 protocol, and we have MuesliSwap, one of the first DEXs that went live on Cardano, that they are very, very early stage, especially because they are being built on new protocols, platforms with a track record that is not comparable to Ethereum at that moment. But also they have the technical infrastructure to facilitate that amount of transactions and maintaining the order book on chain. What you can see on Ethereum, though, with lower transaction throughput is that automated market makers dominate the market. They don't provide an on-chain order book. However, they allow you to swap assets against a liquidity pool and still provide all requirements needed to facilitate direct market access trades. They have a fee being separately displayed, and they have transparent prices that you can see before making a change. I want to close that presentation by reflecting on the key facts about direct market access and to give you a little bit of a hint what the future could bring and look like. So trading OTC dominates the market, and aggregating exchanges, especially a lot of exchanges, is very, very difficult to maintain and build that infrastructure because they all have different requirements. We need a very low latency, and it's being a challenge. But with more sophisticated infrastructure being available in the market, we will see partners picking up that and provide the infrastructure to also allow that for institutional clients. Then I think we were speaking about the liquidity and collateral management issue. The market will be moving away from the deposit first approach in the fight of institutional clients, and we will see solutions that will facilitate that. The key takeaway number 3 is MiCA and other regulatory requirements will push to actually make sure best execution is complied with and more fee transparency. And something that definitely will be added along the way are DeFi applications, which will complement order books of centralized exchanges. And by this, I want to thank you for listening and close my presentation.
Thank you so much, Christian Labetzsch from Blocksize Capital. I'm not sure if you could hear the applause, but it was roaring and you actually filled the room. Yeah, thank you so much for the insightful presentation.